There's a version of you that owns one rental house and a version that owns 11,000 apartments. Same person, same 24 hours. The difference isn't hustle. It's which rung of the ladder you're standing on, because real estate has levels and every level plays by completely different rules. Today we're climbing all 8, from $0 to $1 billion. And somewhere around level 4, almost everyone quietly stops. I'll show you exactly where. Before we climb, you need the 3 rules that govern every single level. Rule 1. Real estate doesn't make you rich because prices go up. It makes you rich because someone else pays the loan. Your tenant buys the house. You keep it. Rule 2. At every level, you're trading one currency for another. At the bottom, you trade time for deals. In the middle, you trade deals for credibility. At the top, you trade credibility for other people's money. Rule 3. Leverage is the elevator and the trapdoor. The same borrowed money that multiplies your gains multiplies your losses. Every level up is a bigger bet. Keep those 3 in your head, because as we climb, you'll watch them repeat, just with more zeros. Level 1. You have nothing. Level 1 is $0. And it's the level nobody talks about honestly. At 0, you don't buy real estate. You buy access to it. That means one of 3 doors. Door 1, you live in the deal. You buy a small 2 to 4 unit property using an owner-occupied loan, live in 1 unit, and rent out the rest. Owner-occupied financing is roughly the cheapest money a normal person will ever be offered, often only a few % down, depending on the program and the year. Your neighbors cover the mortgage. Door 2, you rent out what you already have, a spare bedroom, a garage, a parking space. Boring, effective. Door 3, you become useful to people who already own. You find the deals, you manage the properties, you get paid to learn on somebody else's balance sheet, and a warning that belongs right here, not in the fine print. Low money down means high leverage. It means a small drop in value can wipe out your entire position on paper. Level 1 is cheap to enter and expensive to get wrong. Walk in with reserves, not just enthusiasm. Level 1 isn't about money. It's about proximity. And here's the uncomfortable part. Most people who never make it past level 1 didn't fail at level 1. They never actually started it. Level 2, you own 1 rental, 1 door. Congratulations. You now own a small, illiquid, tenant-operated business with a mortgage attached. That's not sarcasm. That's the reframe that decides whether you climb. At this level, the numbers are brutal and honest. Rent comes in, out goes the mortgage, the taxes, the insurance, the maintenance, the vacancy, the management. What's left, the cash flow, is often small. A couple of $100 a month if the deal is decent, and new investors get furious about that. They expected a fountain. They got a drip, but you're not being paid once. You're being paid 4 ways at the same time. The cash flow, the loan being paid down for you, the appreciation over decades, and the tax treatment. Depreciation can let you show a paper loss on a property that's actually making money. 1 door won't change your life. 1 door proves the machine works. That's the entire point of level 2. Level 3, 3 doors become 10. This is where amateurs and operators split. And it happens over one boring word: systems. At 10 doors, you can no longer remember which tenant pays late, which water heater is ancient, which lease ends in March. So you either build a system, a property manager, a bookkeeper, a reserve account, a repeatable checklist, or the portfolio starts managing you. This is also where the engine appears. Buy something underpriced, fix it, rent it, refinance it at the new higher value, pull most of your original cash back out and go buy the next one. Same dollars, recycled. Investors call it the BRRRR method, and it's how a small pile of money turns into a growing pile of property. And this is where the first real filter sits. Around level 3, most investors plateau, not because they run out of deals, but because they run out of down payments. Remember that. It's the entire reason level 6 exists. Level 4, you stop buying houses and start buying buildings. Here's the shift almost nobody explains. A single-family home is priced by what the house next door sold for. Emotion? Comparables, but a commercial apartment building, 5 units and up, is priced by the income it produces, divided by the return rate investors expect in that market. That's it. That's the formula, which means something wild happens. If you raise a building's net income, you don't add that amount to the value. You multiply it. Trim $10,000 a year in expenses, and at a typical market rate, you may have just created a couple $100,000 in value. Out of thin air. Well, out of a laundry room and better management. Here's roughly how that math feels. Say buyers in your market expect around a 6% return. A building earning $60,000 a year is worth roughly $1 million. Push that income to $70,000 and the same building is suddenly worth closer to 1.2. Same bricks, different business. This is called forced appreciation, and it's the real reason serious money migrates from houses to apartments. At level 4, you stop being a landlord and start being an operator. The building is a business. You're running it. Level 5. Tens of millions in property, and something strange happens. You get smaller. Because at this level, you're not the one showing apartments or unclogging anything. You have a team, a regional manager, a construction lead, an accountant who actually specializes in real estate. Your job shrinks down to 3 things: capital, deals, people. The banks change too. You've graduated from consumer loans to commercial lending, where the property's performance matters more than your paycheck, where terms are negotiated instead of posted, and where loans often balloon after 5, 7, or 10 years and must be refinanced. That last part matters. Write it down. Commercial debt has an expiration date, and what the market looks like on that date is not up to you. Level 5 is the first level where you could genuinely stop. Great income, real freedom. Most people who reach it should probably stay. The ones who don't are chasing something specific, and we're about to see what it is. Level 6, and this is the level that breaks the pattern. Everything so far had a ceiling. Your own money. Level 6 removes it. Instead of buying $100 million portfolio with your cash, you raise it. You find the deal, you structure it, you bring in investors who supply most of the equity, you put in a slice, you run everything, and you earn fees plus a share of the profits above an agreed return. This is syndication. In the US, it lives under securities law, which means real lawyers, real filings, and real rules about who you're even allowed to ask. And understand how you actually get paid here: a fee when you acquire, a fee to manage. Then a share of the profits, but only once your investors have cleared their agreed return first. Investors before sponsor. Flip that order and you don't have a business. You have a lawsuit. Notice what actually changed. You didn't get richer. You got trusted. That's the currency swap from Rule 2. At level 6, your track record is worth more than your bank account. Your net worth stops being the limit. Your reputation becomes the limit. And that's a much harder thing to build. It's also much easier to lose. Level 7. You stop raising money for deals and start raising money for you. The difference sounds small. It isn't. In a syndication, investors say yes to one specific building. In a fund, they hand you a pool of capital and say, go find them. You get discretion, speed, the ability to walk into a negotiation and close without asking anyone's permission. In a competitive market, that alone is often the whole advantage. And now, the buyers across the table have names like pension fund, insurance company, sovereign wealth fund. They're not hunting for a bargain. They're looking for somewhere safe to park enormous amounts of money for decades. They'll accept lower returns for that, which means they can pay more than you can. At level 7, you're not really in the property business anymore. You're in the asset management business. The buildings are the product. Capital is the customer. Level 8, $1 billion. And here, the game changes one final time. At the top, the biggest players usually stop buying buildings and start creating them. Development, you buy dirt, you fight through zoning, permits, and years of approvals. You finance construction, and you produce a building where there wasn't one. It's the riskiest thing in real estate. It's also where the largest margins live, because you're not paying somebody else's profit, you're making it. And then, there's the exit most people never see coming. At this scale, you can turn the portfolio itself into a security, package it into a REIT, list it publicly, and suddenly millions of strangers can buy a piece of your buildings on their phone. And at this altitude, you're not competing on hustle anymore. You're competing on the cost of your money. Whoever borrows cheapest can pay the most, wait the longest, and survive the deepest downturn. That is the entire competition. The illiquid becomes liquid. The empire becomes a ticker symbol. That's level 8, not a landlord, not even an operator. At this point, you're closer to a bank that happens to own real estate. Now, the part these ladder videos usually skip. Every level up increases 3 things: leverage, complexity, and the number of people who get hurt if you're wrong. Real estate moves in cycles, and the cycle does not care how smart you are. Interest rates rise, and a building's value can fall while the building itself is completely fine. Same tenants, same rent, lower price, because money got more expensive. Ask anyone who had a loan coming due in the wrong year, which is why the wealthiest operators are usually the most boring ones. They keep cash, they fix their interest rates, they buy for income, not for the hope of a resale. They assume a bad year is coming, because eventually it always is. And notice who tells you none of this. The person selling you the course is usually operating at level 2 with a level 8 thumbnail. The real operators tend to be quiet because their reputation is the product. And here's the honest math. Almost nobody reaches level 8 through real estate alone. Most billion-dollar portfolios were built on a fortune that came from somewhere else, or across 3 generations, or with an appetite for risk that would keep you awake every night of your life. So, and where does that leave you? Here's the reframe worth keeping. The ladder isn't a race to the top. It's a menu. Level 1 buys you a start. Level 3 buys you a safety net. Level 5 buys you your time back. And honestly, for most people, that's the actual goal, wearing a different costume. Everything above it is a business you've chosen to run, not a life you've chosen to have. So the real question was, never how do I get to $1 billion? It's which rung is enough? Pick that number, then work backwards from it. Because the person who knows their number and stops is playing a completely different game than the person who never had one. If this made money feel less like a mystery and more like a map, subscribe to Capital Compass. New breakdowns every week. This is education and entertainment only, not financial advice. Go find your number.